Well, the most significant change in terms of the payroll deductions is the fact that income replacement policies are no longer tax deductible. Up until February 2015, income replacement policy premiums were tax deductible in the hands of the employee. In other words, if the employee earned a salary of about 10,000 Rand a month, but he contributed towards an income replacement policy of, say, 500 Rand a month, then he would have only been taxed on 9,500 Rand. But from 1st of March 2015, the income replacement policy premium is not tax deductible anymore, and therefore the employee would now be taxed on 10,000 Rand. So it has an impact on the net salary of the employee and the tax that the employee is paying. Another payroll deduction that employers should be aware of is the fact that the Minister mentioned in the budget speech that the UIF limit will be decreased for a year, for a temporary period. And that basically means that the UIF contributions will be decreased, which means every employee will contribute a lesser amount, up to 10 Rand. That will be the maximum amount that the employer and the employee will contribute. To make the changes easier, small business owners should just make sure that they have a proper payroll system in place. That will ensure that all these calculations, the changes in the budget speech, the changes in the legislation will all be implemented automatically, so that small businesses don't have to worry about all these tax changes and UIF and SDL changes, but can just focus on running their business. Although a proper payroll system will be able to calculate and implement all these changes automatically, I think it's important for employers to be aware of these changes, especially to be able to explain the changes to the employees, for the employees to understand why their net salaries are now different. So once the employer communicates that to the employees, then it will make the changes or the implementation just much easier. It was announced in the budget speech that tax-free savings accounts will be made possible. Now, basically what that means is, and all the regulations have been published, and what it basically means is that each individual will be able to contribute an annual limit of 30,000 Rand towards a savings account, and you have a lifetime limit of 500,000. And that just means that all the contributions towards that account will be made free from tax. So in other words, it will not attract any income tax, dividend tax or capital gains tax. Now that is different from another savings account, because normally you would have to declare all the interest made on another savings account, and only a certain portion was exempt from tax, and you would have been taxed on that excess. So this makes it possible for all South Africans to save. Deadlines, which are important for employers. Now, if we look at, except for the normal deadlines, which is the 7th of the month, taxes or pay as you earn, UIF and SDL should be paid over to SARS before the 7th of every single month. Now, the most important deadlines, other deadlines for now, is the fact that the employer, the annual reconciliation period, has started on the 1st of April. Employers have 2 months to submit the reconciliations to SARS, otherwise penalties and interest will be levied. So before the end of May, they should submit their annual reconciliations. Another deadline employers should keep in mind is the fact that the OID submissions, the return of earnings submissions, should be completed and submitted to the compensation fund before the 31st of March every year. However, for this year, the deadline has been extended to the 31st of May. SMEs can use the Employment Tax Incentive, or ETI, to their advantage if they are familiar of the criteria, how to claim the ETI, and if they have a proper payroll system again, which can calculate all the ETI amounts. Now basically what the ETI will do is it will reduce the pay-as-you-earn liability of an employer every month if the employer employs youth which comply with all the criteria or the conditions. This can save companies, especially SMEs, a lot of money in terms of their pay-as-you-earn, and that money they will be able to use again to employ more employees.